Hello, I'm Katrina Scott, Chief Investment Officer of Mariner Wealth Advisors. Welcome to our 2019 Crystal Ball Outlook. I'm joined today by Jeff Krumpelman, our Chief Investment Strategist. And during our time today, we'd like to provide you with a quick review of 2018, but more importantly, we want to share what we envision playing out in the economy and the financial markets in 2019. So Jeff, 2018 certainly ended in a disappointing fashion. After the nice 10.6 return recorded by the S&P 500 index through the end of September of last year, stocks sold off 15% in the fourth quarter and then ended up in negative territory. Specifically, the S&P 500 declined 4.4% for the year, which did include dividends as well. And then, of course, there were also a lot of negative headlines and policy concerns out there, angst about a potential trade war with China, significant nail biting about overzealous Fed rate hikes. And then, of course, the R word came into the conversation with investors increasingly worried about looming recession. So what's our perspective or take on all of this?
Sure. Yeah. Well, as you and I have talked often, Katrina, we did feel like investors just became overly pessimistic and kind of uber skeptical, if you will, late last year, and they just were assuming worst case outcomes in virtually everything, and it wasn't supported by the data when we looked at it. So we thought we'd start with a cartoon this morning, where it's just a little attempt, I guess, at PM humor, and I'm sorry that it's not better comedy. But both you and I agree that we investors in general just need to lighten up a bit. And the cartoon makes the great point that not just in December of 2018, but actually going all the way back to the very beginning of this bull market advance, that this has been the most doubted, disrespected bull market on record. And every time that we've had a slight sneeze in equity prices during the kind of bull advance, again, going all the way back to the beginning, investors wanted to call it a top. And that cartoon brings that to life. You see that, oh, here's the top. No, this is the top. No, this is the top. As the market continued to climb that wall worry. And we don't think that December of 2018 is any different from some of these previous moments. And let me take you just a real quick of a walk down memory lane, because I think we seem to forget these moments and think that this has just been ponies and rainbows, and it's not been that case. Starting in 2010, we saw a 16% correction that year as people were wringing their hands over midterm elections and the sunsetting of Bush tax cuts back then. Market caught an edge, moved to higher highs, and then in 2011 we saw a 20% correction in the market. At that time, it was around Arab Spring and riots in Europe, the U.S. debt downgrade. And then, of course, 2012 and 2013, good years. In 13, we were up over 30%. And then in 15, we experienced a 12% intra-year pullback. That was mostly about China. People worried about a hard landing in China. And, of course, one of the better illustrations of one of these panic attacks that we've seen was early 2016. The market pulled back 11% or so, and it was the triumvirate of concerns then. First was plunging oil prices. That must mean that we're going to have a recession near term. Brexit was supposedly going to cause global depression, and I think the headlines read, if Trump is elected president, we're going to have a stock market crash. So at each of these moments, if you took action and you sold, you left significant money on the table. And it was more psychology, not the hard data, that caused these kind of pullbacks. The headlines would create fear, but then the data would be released. It was still positive, and you'd get the recovery. And again, we think 2018 is similar to that. We think that what we saw was a normal correction. We're seeing this return to normal volatility after below normal levels of volatility for over a year or so. And I got to tell you, as portfolio managers, while we get butterflies too, we embrace that volatility at moments like this and hold positions or use it opportunistically. And I can remember just recently in December, in the midst of this, being on CNBC, and we were talking about the data being still positive, and we don't think this is the time to run to defense. And right next to my mugshot on CNBC was this kind of slogan, worst December since 1931. This is not 1931, and we've seen just in January of this year the best January since 1987, and you don't see that in the headlines. So we think that people had become overly pessimistic, discounting worst-case outcomes primarily on trade and on Fed, and that translated in their minds to earnings were going to go from great to horrible in 2019, and we think they're going from great to still healthy, positive. They're slowing, but still positive and okay. And that kind of cocktail of more attractive valuation, the economy and earnings still solid but moderating, yet sentiment being uber skeptical, that's a pretty good setup for returns in 2019, the way we see it.
Okay, got it, Jeff. So basically, we remain positive on equities until investors just got too pessimistic there towards the end of the year. So why don't we now, focus on just last quarter? Could you quickly walk us through that?
Yeah, I hate to
last quarter of the year, I mean.
Sure. I hate to make folks relive this, but maybe a couple points to come out of it. If you look at the table on the left here, it shows you the returns through September. And as you mentioned in the intro, we were having a pretty good year in the S&P 500 all the way up through September. At that point, the market was up almost 11% for the year. And wouldn't it have been nice to have maybe stopped the calendar right there? We were still up in December. Early December, the market was up about 6%. But kind of comments coming out of the Fed about, I think it concerned folks that maybe they weren't going to be as data dependent and measured as hoped for. Their communications could have been better, but I think it was more of a communications problem than a policy problem. They made that really clear in the early part of this year that was the case. And then we had more angst about trade and exactly, how was that going to work out? And folks got a little over skeptical about worst case outcome there. And that did lead to a 15% sell-off in the quarter, and then for the year we ended up down about 4.4%. But a couple of key points here I think would be, hey, 4.4% decline is not 1931. That's a normal kind of pullback in a calendar year, and if we can't weather a 4.4% calendar year decline, it's really tough to be in equities because that's quite normal. Particularly when the data remains positive, it's an opportunity, the way we see it. So that would be point number one. This is not 1931. The other element or point to make here is look at the other indices, like small caps, as illustrated in the Russell 2000 index, and then the international indices. They were down more. They were down double digit. And we have, for our clients, the preponderance of our asset allocation in large cap U.S. oriented stocks at this time. And so just knowing that a very large component of your portfolio was in the better performing asset class, that was a good decision in a relative sense. And so we had more exposure, much more in U.S. large cap than we did in small and international. That was a positive for the year.
Great, thanks, Jeff. And then what about even just looking at that chart that you just went through on the asset class returns over those various time periods? There's a lot of variability in those returns. So what about the consequence of all of this unprecedented high level of volatility, that was talked about in headlines, but that also we saw at the end of 2018 and even moving into 2019?
Yeah, sure. So this just brings to light, and again, we talked about this a lot, the myths that are out there, just the untruisms, if you will, that are out there. One of them is that volatility is at quote-unquote unprecedented levels. We've heard that so often, or was, at the end of the year. That's just not true. And I'll address that in these charts in just a minute, but I think it's very important in our communication with our clients these myths that get out there that are negative in nature, they scare people, and they can actually motivate and incite decisions that cost folks in terms of their portfolio. So I think it's good that we try and make clear that these things are just, not factual. So another myth that's out there that I would bring up before getting into volatility is government shutdown. I've heard so much that the economic pain from this shutdown is unprecedented. That word is used a lot. And the facts are that 1996 is an example of one of the shutdowns. That was a 100% government shutdown, unlike a 25% government shutdown that we just recently experienced. The economic impact was far greater. This shutdown would have lasted almost 4 times the length of time that it did for it to equate to the economic damage that occurred back in 1996. So, that's just another untruism that's out there that frightens folks. Fiscal stimulus, they talk about how the tax cuts. I've heard so often that one of the big fears out there is that fiscal stimulus is fading this year, and that the benefit of stimulus from tax cuts is going to be far less this year than in 2018. That's not true. The fiscal stimulus from tax cuts that were enacted in 18 will be $275 billion this year. There were only $200 billion in terms of stimulus for the economy last year. So fiscal stimulus is not fading, and I think that's unappreciated. That's something that's not a headwind, but a tailwind for the economy. And then another myth is that when earnings growth slows, that translates into poor stock returns by definition when earnings moderate. If you look at the data, the 80s are a good example, the 90s are a good example, 15 and 16. Earnings moderating can be very healthy for stocks. It's when earnings growth is actually too strong or it just collapses that it's a real issue. So, we need to kind of right the ship on those kinds of assertions as well. But on this one, yeah, we were being told in the headlines that volatility was unprecedented. I've heard people say in their entire 30-year career they've never seen volatility so high. Let's look at the chart. And on this left chart, the chart on the left-hand side, it captures the volatility index, or the VIX, the so-called fear gauge, the volatility, proxy for volatility in the stock market. The red line is the average volatility level, the average VIX measure going back for a number of years. And what you see is, in the dark line, that plots the year-to-year volatility that's recorded. It did go from below average to just ever so slightly above average towards the end of 2018. But it certainly is well below what we saw in 2011 and 12, way below what we saw in kind of 07, 08, 09. So to say it's unprecedented just isn't factual. And if you look at the right, this blue line, which is kind of an EKG, it captures the daily percentage price swings in the S&P 500 over time. Note again, in looking at the volatility in that line, that it's not unprecedented. In fact, the level in this measure is about equivalent to that in 15 and 16 and 11, 12, and way below what we saw in 07 to 09. So again, just something that can scare folks, and it's not true.
Great points, Jeff, on some of the investment myths that are out there. Clearly, fake news exists in the investment world as well as all the other places. So why don't we focus a minute on the difference between a normal correction and deep, dark bear markets, generally linked with periods of economic recession. I know, that you and I talk, and we both feel that it's important to distinguish between the two, and these two very different scenarios call for entirely different responses from an investment advisor. Can you talk about this a bit, as I think, that we both really believe that this is an important thing for our clients to appreciate our thinking on?
Yeah, absolutely. And, they are far different. They call for different kind of reactions. And one of the things that is a key philosophy or tenet of our investment approach, Katrina, which you've helped author here, is let's don't confuse activity or progress and activity. And just taking action isn't valuable unless it does add value. So this is one of those examples where there is a big difference between a normal correction that can be of, relatively significant magnitude, 20% or even a little bit higher in terms of correction, but it's over shortly. We get over it in very swift fashion. It's not associated with economic recession. There, you really don't want to take significant action. You want to hold your positions, maybe upgrade a little bit. If you have some excess cash, maybe put it to work as security prices have kind of become more attractive. But you don't want to take a lot of action. That is far different from a deep, dark, multi-quarter, multi-year bear market that is associated with economic recession, and it can last for some time. There you do want to maybe raise a little cash, become a little more defensive in the construction of your risk portfolio. And so I think this chart brings to life the difference between these two and helps to understand why you take action in one and not in the other. So if you look at the green arrows, these are examples of normal corrections, not of insignificant magnitude in any way. The first one, 1987, you can see that that blue line declines quite a bit. We had a 22% pullback in the market in one day in 1987. From peak to trough, it was a 34% pullback. But you notice that the market catches an edge pretty quickly, begins to recover and advance and go on to higher highs, and it did that for over a decade after that moment. Another example within that kind of bull run was 1998, where you again have a wiggle in that line, but that's a nice wiggle. That's a 20% pullback at that point in time. Folks were concerned about Asian currencies, and you had this thing called long-term capital management. But it wasn't reflected in a weak economy or in the data, the earnings data out there. Things continued to be pretty strong on the fundamental front, and it was more psychology that pulled that market back. And then we went on to higher highs over the next year and a half. So those are moments, again, where you hold your ground. You don't get worried and caught up in the emotion. That's far different from these two other periods, like 2000 to 2002 and 2007 through early 2009, where you did have real economic pain, and you could see it in the data. So, 2000, 2002, we all remember, that's 9/11, a horrible moment, along with the bursting of the tech bubble. And we may forget that, you had CEOs that were going on trial for cooking the books. WorldCom, Enron, Tyco. Not only were earnings in decline, but in more than one case, they were fake earnings, accounting gimmicks. So that's a moment where you want to be cautious, defensive, and make some portfolio adjustments. Similarly, 2007 to early 2009, the housing implosion. Don't need to talk about financial institutions that went under, that didn't survive, or that barely survived, and so on and so forth. But let's look at the data. In that time period, we were losing 700,000 jobs a month in this country. Now contrast that to today, where you're gaining 300,000 jobs a month. And if you went away to an island and you came back, a couple months ago, and you came back today, said, "Hey Jeff, I haven't read a newspaper, haven't seen anything. What's going on?" I said, "Well, the economy is gaining 300,000 new jobs a month. We have record level lows in unemployment. We have unemployment claims that are at the lowest level since 1969. Leading economic indicators are healthy and rising. We've got pretty nice strength in manufacturing and service activity. The consumer is strong, so on and so forth." You would be talking to your financial advisor, making sure that you have healthy exposure in equities. And that's what we see today. So we just try and contrast between moments where there's psychological pullback, where the data is strong, versus periods where, hey, the data is not good and you better be considering some adjustments. I think the next chart, Katrina, really is helpful. I'd like to share it with all clients. I think, you know, the more frequently we do this, the better. But the chart on the left is a graph of the price returns of the S&P 500 going back to 1980. The gray bars capture that annual price return. And the first thing that should jump off the page is those gray bars, 75 to 80% of the time, are in positive territory. So it doesn't really pay to be negative on the S&P 500 on a consistent basis here. Most of the time, the S&P 500 does quite well. There are rare occasions, and you see those gray bars that are negative. There are rare occasions where that happens, but I think you want to make sure that the data drives you there, not just some emotional moment in time that you swiftly kind of pierce through. And you can see the red dots capture within each year the peak to trough intra-year corrections that occur. And in many years, you get healthy corrections, and yet the gray bar is still positive. And let's go to these 2 points that we've been talking about. 1987, 1998 happened to be moments in time where that did occur. You had a 34% correction in 87, but you still had a very modest return. I think the more important data here, though, is look what happened after the 87 correction in 88 and 89. Very healthy returns. So you had this significant pullback, not unlike what we saw in December of 2018. 18 was more like 19, almost 20%, not 34, but you have that significant pullback. And then see what happened in 87 when there's no recession, good returns that ensue. The same thing in 98, you have that pullback. The market ended up still up 27% in 98, but you had that 19% pullback. The next year you're up 20%. And I'm not making a call that would have that healthy of a return from this point, just saying you want to distinguish these whiplash moments of time where you don't want to sell and run away because of headlines when the data doesn't support it.
Great points, Jeff. I think especially that chart that you just covered, I think really does help people see that over the long term, you're better off, being in the market than not being in the market. So now that we've covered the importance of the distinction between environments characteristic of normal corrections versus something that, may be much, much worse. Let's shift gears can you talk about what's our base case forecast for 2019 as we look ahead?
Sure. So the table kind of brings it to life. The green highlights what our base case is. And so we have a 65% probability assignment to a pretty decent year. We were looking, and we established this as a team back at the end of the year when we were just kind of in the middle of the abyss. We put a target of 2,800 on the S&P 500, which translates into a price return of 14% from that point in time, 16% total return including dividends. And it didn't take a lot to get there. All we're looking for there is a deceleration in earnings growth from 25% in 2018 to about 7 to 8% in 2019. We think that's pretty realistic, and we think the PE multiple will be somewhere around 16, not far from where we're at right now, and that translates into a pretty good year. We do think that there's a chance that it could be better than that, and I think what would get us there would be pretty good resolution, confirmation that the Fed indeed will be very measured, pause in their rate hikes. That would provide a lift. It's already provided a lift early in the year where it looks like we're headed that direction. Same thing on trade, that would be resolved in less than worst case outcome fashion. That could lift earnings a little bit, cause CEOs to spend a little bit more, get a little more multiple, PE multiple from investors, and that would translate to a 24% total return perhaps in the optimistic case. Let me update you. since we've already seen in the early part of the year, the market's up almost 10% for reasons that we thought, supported that. Now, from these levels, these targeted price levels on the S&P would translate into our base case to a 5% return, and our optimistic case to a 12% return. So still, positive advance from here and healthy returns. If we would see, the market at these more optimistic levels, we'd have to revisit and say, okay, what do we think about this from here? What does the data look like? Do we want to make any adjustments? But still, the expectation is pretty solid. We do outline pessimistic cases that could occur, and that would be if we didn't get good resolution in some of these things, and if the economy would slow, and you see the downside that we see. This isn't horrific, but it does show you that we're open to adjusting our view if the facts change.
Great. So really sounds like looking at that base case, sober but positive results. What about things that keep us up at night? We talk a lot about, the wall of worry list that's out there. When would let's shift gears to that wall of worry list, and when would these items get us to adjust our thinking?
Sure. Yeah, well, Katrina, we worry all the time, and maybe that's a little, diet control too, weight control or whatever. But, I think that as portfolio managers, we're actually paid to be paranoid, hopefully in a healthy way, but paranoid to maybe take some of that worry off of our clients' shoulders and assume that. So as part of that, we keep a running tally of what we call the wall of worry, the rolling wall of worry. And there are a number of items on this list to worry about. And the first thing I try and share, and we try and share, is that the time to worry is when there is no wall of worry. The fact that there are a number of items on the list tell you that investors are skeptical, they are respectful of risk, and so valuations just don't get out of control. If there's nothing on that wall of worry list, in our experience, that's when things can not be good for the equity market. So first of all, it's a good thing that this exists. The second point to it is that we critically examine and try to do that in an objective fashion, each of these, and ask ourselves, are investors baking in worst case outcomes on all of these items, or are they being conservative in the impact of these? And we would say today that they have been overly pessimistic, certainly back in December. Folks were just assuming, for example, that Fed policy, that a mistake was going to happen, that the Fed was tone deaf, it was not going to pause, it would not adjust to the data and be data dependent like they said they were, and was just going to hike. And we just didn't think that was the case. It made no sense to us that the Fed, whose mission is to create economic stability, would pursue policies that were tone deaf, that would cause instability. And, I think that they've made that clear so far this year that they get it and that they're going to pause. In terms of trade, that's another example where we didn't think it made sense to just jump to the conclusion we're going to have a trade war here and that nothing would come from this. You have two parties that were highly incented to come to some resolution. Trump wants to get reelected in 2020. And the worst thing that in a campaign would be to have to defend the fact that you're in the midst of an economic recession. So he's highly incented to push through to an agreement, as is China, where Xi Jinping doesn't want a hard landing over there. That is very hurtful. So both of these parties are highly motivated to come together. We think it's common sense that they will, and it looks like there's good progress on that front. But at the end of the day, and this is the third point on this page, forget our judgment and how we feel about them. Do we see these headline issues? Do we see the impact of them being reflected in the data? Because that tells you if it's hurting or it's not. So we look for this rolling over to and spilling into elevated risks of recession or risks of inflation. And we look at specific signals or indicators to identify if that's happening. So we ask ourselves under risk of recession, hey, Has the yield curve inverted and gone negative? Have the leading economic indicators deteriorated significantly? What about some of the other market and economic metrics? Unemployment, is it spiking? Is the Purchasing Managers Index data, which is a measure for activity in the service and manufacturing economy, is that rolling over and going negative? How about earnings growth? Is it collapsing? And the answer to all these is no, 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 no. It's not. They're actually at healthy levels. Same thing on risks of inflation. Is wage growth, it is rising, but is it that horrible choking point where it can impinge margins? No. Is inflation, as in CPI, running amok? Absolutely not. It's at very comfortable levels. So we look for the facts and the data, and if it changes, that's when we will adjust things and try and listen to the data.
Okay, so in summary on the wall of worry then, Jeff, what you're really saying is that we're looking for signals that these headline worries are actually spilling into this hard data that you're referencing. And there are specific indicators we're monitoring that we think best signal that. But right now, they aren't signaling recession or runaway inflation that truly are the risks that end bull markets.
Yeah, that's right. And, so we've kind of taken a shotgun approach and just thrown a lot of items out here. Why don't we, in the next couple of slides, just look at a couple of these so you can get a feel for the research process that we go through to make these judgments. So this next slide gets at earnings. And there's this thought out there that if earnings growth moderates, that, that is, by definition, translates to poor equity market returns. Here you can see in the 80s and the 90s, the blue bar represents S&P 500 returns. The red bar reflects earnings per share growth on an annualized basis. And you can see in the early 80s, where earnings growth decelerated, actually went slightly negative, not significantly, just ever so slightly negative. The market did really well. And so things were moderating and resetting, but we weren't moving into deep, dark recession, and that gave a lift to the markets. And for the decade, where you had fairly subdued earnings growth of only 5% for the decade, look at the S&P 500 returns. You had similar periods in the 90s, and I could talk about 15 and 16, where similar things happened in those years, and the market did just fine. So where you really get into trouble is if earnings growth runs amok and just gets away and it's too strong, or it absolutely collapses. So that's point number one. The other charts, the next one is one of the key indicators that we look at that's talked about a lot. It's simply called the yield curve, and it measures the slope of this line is the spread between the 2-year Treasury and the 10-year Treasury. So when this gray line is moving up, that's saying that spread, the 10-year is higher than the 2-year, and the spread between the two is getting higher. And that tends to happen when people believe that we're in real growth mode and the economy is expanding nicely. When it's going down, the opposite's occurring, that spread is shrinking. That can be a sign of a slowing economy. But what we find as an indicator, this is very powerful, it always goes negative prior to recession. And it does it in advance. And so you can see the last 3 recessions where the yield curve not just flattens, but it goes negative. So it is flattened. If we would update this for this year, it's steepened just a little bit from that low point. But you can see in the 90s it flattened significantly, and that was a wonderful time for stocks. So it's not the fact that it's flattening. That can do so for a multi-year period, and the market still do fine. It's if it goes negative. And even if it does go negative, you have about a year advance warning on average before it leads to recession and bear market. And I think that's critical. Some of your best returns do come slightly after it goes negative. So you want to be very careful. This is just one of the signals we look for before taking action. The next slide also is a powerful indicator. It looks at activity in manufacturing and in our service level or our non-manufacturing economy. And by the way, manufacturing is about 12% of the U.S. economy. Service or non-manufacturing is about 88% of the economy. And so this line tracks surveys of purchasing managers that answer questions about what they see in terms of activity in their companies. Are you hiring more? Are orders coming in a significant way? Are delivery times being stretched because it's hard to meet demand? If these lines are above the 50 level, that index level, that red line, it means things are growing in those sectors. If it's below 50, that means activity is in decline. And what you note again in these gray shaded areas, which are recessionary periods, both of them must go negative before it signals recession. What you see now is not only are both positive, are above 50, but they're actually trending at a healthy level. So we would look for this, and you can see in 2015-16, we got concerned because that manufacturing, that dark line, fell below. It was not confirmed by service, but that got our attention. We were looking at that point saying, what do we think? We got to see this other go negative. It didn't, and so we were calmed. But that's the kind of stuff we're looking at.
Great. Those are great examples of the indicators that you were referencing earlier. So thank you. So how about shifting away from all the potential downside risks and negatives to look out for? Are there any catalysts out there that could provide an upside surprise to investors this year?
Yeah, wow. That's a great question. If that would have been posed and I would have answered that back in December, I think our families would have been threatened or something. People were just in a negative, kind of crabby mood, and you didn't want to talk about glass half full or opportunity. We did talk about it, but you needed to be careful to be taken seriously. So yeah, there are things out there that represent walls of opportunity that could give lift to the market to a greater degree than we expect. A couple of them, just to highlight, how about business investment spending? It did pick up in early 2018, but kind of plateaued a bit towards the end of the year. And I think it was because of CEO concern about trade and the stock market kind of pulling back, just made CEOs a little more cautious. Should that resume growth as we've seen the stock market recovery, as we get resolution on trade that's better than feared, and at least it's not uncertainty, we know the rules of the game as we move into 19, that could cause capital expenditures to rise again and help drive productivity, allow wages to increase without impinging margins. So that's a catalyst that we're monitoring. Innovation, we need to remind ourselves that the U.S., certainly technology is an example, we're the most innovative country in the world. And so, yes, China has this 2025 plan to grow their technology sector significantly, but two of their companies, Huawei and ZTE, almost went under because they are dependent upon the great components produced by U.S. technology companies. And if they don't get them, they can't do what they want to do. So innovation continues here in the U.S., 5G, other things that happen this year that can provide a greater lift than maybe appreciated. And then if we do get better resolution on the kind of mainstream things like tariffs and trade and Fed pauses, that's good. If oil stabilizes at these levels, gas prices are still very low, but if oil prices stay up, that helps energy profitability. So that could give a lift to earnings in the market. And these are all things that could be upside surprises. If you look at the next slide, it gets at that productivity kind of graph. A big story, and we're empathetic to this in the bearish camp, is we've seen declining productivity. And we do need to see that continue to lift. It started to do that in 18 as CAPI started to pick up a little bit. We will monitor this to see if it can continue because it's important that we see that happen. If wages do start to accelerate, you need greater productivity so that wage growth doesn't really pinch margins to a great degree. Something to really take a look at.
That's great. So we've, reflected on 2018, talked a little bit about what we're already seeing in 2019, hit our base case, hit the wall of worry, hit those potential opportunities that are out there. So why don't, Jeff, to wrap up then, how would you summarize the process we use to make these judgments we've been discussing today? Can you briefly bring that to life for everyone to kind of wrap up this session and how we look at all of this stuff together?
Absolutely. Whenever a client asks you or I or anybody on the team or how we're thinking about the market, we look at three levels of analysis. We look at fundamentals, we look at valuation levels, and we look at technicals. And I think all of us probably could stand to benefit from doing yoga a little more often than we do, or run or do some cardio stuff a little more often than we do to calm the mind and the emotions. This is what calms us. This is what gives us clarity. So we look at all three levels. We rate these three different types of analysis as positive, neutral, or negative. And the first thing that we kind of tell clients is, if you're in discussion with us and we show you this chart, which we do, we're transparent, and there's a lot of green checks here in the positive column, let's all relax a little bit. Let's all calm. If you see a lot of yellow and red, you probably want to be asking, what are we doing as a result of that? So right now, there's a fair amount that's in that green category. That's a good thing. There's a lot of positives. Under the fundamentals, you can see what we look at. We look at the trends in the economy, which we talked about, earnings trends that we talked about. How about Fed policy? Is it measured, or are they hiking like crazy? It's measured, so we rate that as neutral. How about interest rates? Are they extremely high levels? No, they're low. How about credit spreads? If they're tight, that means that bond investors aren't worried about defaults. That's a good thing. Gives you a measure of how the economy is doing. We look at valuation on several fronts. We look at price to earnings and other measures. We would kind of, in a soup bowl, put that overall in the neutral category. I actually think it leans more positive. To update price to earnings, we'd really come in from more neutral levels towards the end of the year. So valuation actually leans a little positive. And then on the technical front, we try and see what price trends are trying to tell us and what kind of psychology measures we're getting from investors that give us a feeling for the psychology in the market. So if you look at the number of stocks advancing versus declining, this year this has improved in a big way in January, and we've seen broad participation in the market as opposed to 18, where we had a narrow market and just a few stocks leading. Now we've got more cyclical-oriented stocks in a number of sectors outperforming, where only a few sectors did well last year. So we put that in the positive column. If we look at things like sentiment, folks are very negative. In fact, going into this time last year, 51% of folks felt like the market would be positive in the ensuing 12 months. Only 31% feel so this year. That's actually a contrarian indicator. It says people are sober and skeptical, very respectful of risk, and when sentiment levels get low, that tends to be a good signal for the market. So when you mix this up in a big soup bowl, this is our yoga chart that calms us, and it says this is why we're positioned the way we are, and believe that the market will do fairly well next year.
Thanks, Jeff. I think that really summarizes things very well. I like, it also points back to the fact that we are paying attention to the data, not the headlines, and obviously the colors here back to the base case and why we're so positive on the year. So that really concludes all of our remarks today. Jeff, thank you very much for going through all of that for our clients. And thanks to all of you, our clients, for listening in to this crystal ball discussion. We appreciate your confidence and the opportunity to serve, and hope that you have found the discussion today helpful. And then we would also encourage you to stay tuned for our mid-year summary. At that time, we'll actually revisit these thoughts with you and discuss how things are evolving at that time. So thank you again.